Welcome to Subramani. We as investors have endured another quarter ended for December with promise of increase in EPS, with increase possibility and promise of increase in private sector capex, but these are being promises and not really coming across, right? So internationally also, if you see aggressive rate hikes by the US, UK floundering, not knowing what to do. Brexit or no, they don't know. They voted for Brexit, hoping to keep themselves clean and without any color people coming in, right? That's what they wanted. They didn't want even Europeans to come in. Well, they got an Indian prime minister or a prime minister of Indian origin. Imagine a brown prime minister in a white country where maybe 85% is white. Not too many people are liking it. So amidst all this, you still have to invest. You don't have a choice of saying I will invest after the turmoil is over. Turmoil will continue to be there. In fact, the biggest turmoil I'm expecting is how are the whites going to react to seeing that the size of their economies shrink or reduce in terms of importance. So there is, I mean, 1 out of 5 or 1 out of 4 people in the NHS is a non-white, right? Or maybe it is even more. So whether it is educated people coming from abroad or not very educated people coming from abroad, they need all their services, and at the same time they are also going to talk about white supremacy. So if you see countries like France, what they have is very huge brands which sell at a premium. What happens if these brands get replaced? What is going to happen? So that turmoil is there. And how is a drop in the British currency or British economy bad for us? Because we do not know how desperate their measures will be, what they will do, because they still think they are a very important part of the world economy, and that's not totally untrue either, right? The pound is important, the euro is important. So amidst all this, again, like I said, you have to keep investing. How difficult does it get? It really gets difficult because you don't know whether. So the typical question is, should I withdraw some money now and invest later? Honestly, nobody has an answer for that. Now somebody watching this video will say, itna gyan de rahe ho, so much you're saying, but you're not saying which fund to buy, whether to invest. I honestly don't know. I can only say what I'm doing for myself. So I'm invested. I'm always invested. The rational part of our brain knows that there is high inflation, increasing interest rates in the US and UK. Japan is still not stopped printing notes. So we do not know how to use this data, right? Washington, Brussels are both printing, but Tokyo are both not printing, and Tokyo has not stopped printing. So how are you going to react to this? Should you be borrowing in Tokyo and investing in Washington? So these international trades, we do not know how that is going to pan out. So amidst all this, you know that you have to sit calm and invest. Now that's easier said than done. But you can ask yourself some questions that do I require money in the immediate 12 months to 15 months? If yes, that money should be in an ultra short bond fund, and if you require money within the next month, it should be in liquid fund, right? You don't want to take any chances with that kind of money which is required almost immediately. Try to control those things which you can. You can control your asset allocation. You can control your costs. When I say control your costs, it means if you have an advisor, see whether there is enough value add by the advisor. Whether you need an advisor, don't need an advisor, whether you are happy with index funds is something which you have to answer for yourself. Make sure that you have adequate insurance. I mean medical insurance, insurance in terms of having a good job in a good company, rather than a high paying job in a not very good company, right? So startups might get a little difficult to survive because there could be a shortage of money, right? So now people have to think that they can get 4.5%, 5%, 4.5% in the US treasury bond. So when they put money in the startup, the margin that they require keeps going up. They say, okay, 4.5, I'm getting risk free. You have to give me 20% return. You have to give me 18% return, because they also know that many of their ventures will fail. So amidst all this, when you are investing, the question is, where should you be investing? What are the questions that you should be answering? So I think three questions. One is, can you time the market? Do you know how to time the market? Have you experimented with your ability to time the market? Then what you do is, you put 80-90% of your money in index funds according to your asset allocation. Whatever money you should be putting in equities, and with 10% or 20%, whichever you have, you try market timing. Don't try market timing with the whole portfolio, because you miss some very important days and your overall return can be very different from what the market investments have got. What the investor gets depends. Somehow people think that out there is somebody who knows what is going to happen in the market. There is nobody. People are all guessing. Some people might be guessing more intelligently than the others. That's about it, right? So you can't really say what the market will do. But I can tell you one thing. People can make money only if they have a long-term view. And a long-term view, I mean, don't take a long-term decision based on what is happening yesterday or today. Remind yourself that you are an investor, not a trader. So you don't need to worry about a day-to-day thing. But on a day when the market falls, you also panic and say, look, I bought the share at 900, now it is 1800, let me sell off at 1750. Yesterday it was 1800, today it is 1750, let me sell off at 1750, and when it comes to 1650, I'll buy it. Now herein the risk is, you sell at 1750, it comes down to 1650 and you say, no, I think it will go down further. Next morning you wake up and it is at 1825, right? So you miss the bus, because being able to get all your call rights every time and to the perfect degree to which means it went down from 1750 to 1650. So you sold at 1750 and you did not put a buy at 1650. At 1650 you got more greedy and you said, oh no, I think it will go down further. Then it suddenly, now you are seeing the price at 1825. Very happily you are putting the say, oh no, I will still put a buy at 1650, but it may not reach 1650, right? What happens if it stays between 1825 to 2040 or 2050 for 6 months? You are just going to, you miss the bus by just 25 rupees or 75 rupees, but because of that 75 rupees you missed another 200 rupees, right? So don't try messing around too much. If you want to mess around with 10% of your portfolio, not with your whole portfolio, right? So what impact will it have? The 10% on your portfolio going up by 5% or 7% or falling by 5% or 7% is not going to make much of an impact on your portfolio, but at least it will help you learn, right? Instead of saying, oh, Subra is talking nonsense, I'm sure he must be doing market timing. You try market timing, see if it works for you. Maybe it didn't work for me, maybe I'm dumb and I do not know how to make market timing work. But I can tell you one thing, by sitting patiently I've been able to create some wealth, right? Enough wealth to say that I need not work for the rest of my life, and I said that 20 years ago. So understand that sitting tight helps. Understand that missing the best days can be very crucial. So don't try timing the market. Once for all, give it up and answer these questions. Let me just repeat. Remind yourself that you're a long-term investor. You will not make. So what should you be doing? So you should be, first of all, understanding what are the things which you can control. You can control how much you save and how much you invest, right? That you can control. You can control your expenses. So do that, or whatever. If it suits you, spend more. Perfectly all right. But see what suits you and what is important. Remind yourself that as an investor, you cannot take long-term decisions based on your short-term mood swings. Mood swings will happen. You look at something and you say, oh my God, I think we are headed for disaster. We are in 2023 already. So we will think, suppose you have a feeling that Mr. Modi is going to come back as Prime Minister. That's fine. But you have to be ready for a contrarian view that Mr. Modi may not come back as a Prime Minister. Maybe BJP will come and choose somebody else. Maybe BJP will not come. We have to be ready for all those probabilities, right? Maybe now it looks impossible that Mr. Modi will come back, but by 2024 you may yourself say, no, we have to give some credence to that, right? So that could happen. So and also next is find some free money in your head and in your pockets. I find this very commonly, people making a mistake of keeping their money in some cooperative bank to earn that extra 1% or 1.5%. And all retired people today are anyway paying a lot of tax, right? So if your pension is good, if your other income is dividend income, rental income, and interest income and all that, then obviously you're paying a lot of tax. Can you make it more efficient? Of course you can make it more efficient by shifting from bank deposits to mutual funds with growth option, in debt fund, ultra short floating rate, long term gilt, whatever, depending on your level of understanding you could do that. So do those things and sit tight and you will make money. But if you think you're going to time the market, try doing it on a small portion of your portfolio, not on your total portfolio. Thank you.